Hello. In this video, we'll be considering how to deal with questions that involve a capital constraint, known as capital rationing problems. We may have loads of good ideas for projects to do, all with positive NPVs, but not enough capital to invest. We'll consider how we decide which projects to do. Firstly, let's consider why we have a constraint in the first place. The capital constraint can be described as hard, which means it's externally imposed. This means the money isn't there and that it can't be obtained in time. It could also be described as soft, which means it's internally imposed. This generally means the money is there, but self-discipline means the company doesn't want to spend it all. It may, for example, want to put some aside in case of difficulties. Often, businesses put together a capital expenditure budget to limit their spending on capital expenditure. This isn't to say that if they spent a little more than that, the business will be in financial difficulty. It's just that the company may not want to spend every last penny it has on new projects. To be honest, whether the capital constraint is hard or soft doesn't change the numbers. Either the money's not there, or it is there and the company doesn't want to spend it. Let's work with an example. Suppose the company's identified 4 projects with the following profiles. Now suppose it only has $300,000 to spend. It can't do all the projects, as this would cost a total of $575,000. Assuming that the projects couldn't be delayed and all avenues for finance have been explored, let's consider how it will decide what our investment plan will be. Firstly, we need to know if the projects are divisible or indivisible. A divisible project means that you can do, for example, 40% of the project for 40% of the investment and get 40% of the NPV. For example, if you were buying a chain of shops, you could buy the whole chain or potentially 40% of it. With indivisible projects, it's either all or nothing. For example, investing in a machine to create a new product. You either invest in the machine or you don't. 40% of a machine is not a machine, it's scrap metal. The question will guide you as to whether the projects are divisible or not. Suppose in our example the projects are divisible. The approach we take to solving this problem is very similar to limiting factors that you may recall from earlier studies. We want to direct our investment, when we have limited capital available, to ensure that we maximize the NPV per dollar invested. So our key calculation is to divide the NPV by the initial investment, sometimes known as the profitability index, to help us rank our projects from most favorable to least favorable. For example, for project A, the profitability index is 50 divided by 100 equals 0.5. And for the other projects, we then rank the projects from the highest profitability index down to the lowest, as follows. As we can see, project C is our preferred starting point. It has the highest profitability index because, as we can see, it gives us the greatest NPV per dollar invested, which is an important consideration when you don't have that many dollars available to invest. Let's set up a pro forma for our investment plan. We'll start off at the top of the rankings and work our way down until we've run out of money. In total, we have $300,000 to spend. Let's put that at the bottom of our working. We can afford to do 100% of Project C as we have $300,000 to spend, and the full Project C only takes $125,000. That leaves us with $300,000 less $125,000 equals $175,000 left to spend. So we move on to Project B, which was ranked number 2 on the list. We can also afford to do 100% of Project B as we have $175,000 left to spend, and the full Project B only takes $150,000. This leaves us with $175,000 less $150,000 equals $25,000. Next on the rankings is Project D. We cannot afford to do a whole Project D, as that will take $200,000 and we only have $25,000 left. However, we can afford to do 25 over 200 equals 12.5% of a Project D. Remember, these projects are divisible. This means it will cost us 12.5% times $200,000 is $25,000, and we assume that it will generate an additional NPV of 12.5% times $130,000 is $16,250. This means, therefore, that the highest NPV we can generate if we have a capital constraint of $300,000 is $216,250. This is the total of the NPV column. In summary, if the projects are divisible, then we'd want to do 100% of Project C, 100% of Project B, and 12.5% of Project D. If the projects are indivisible, then the only approach we can use is to look at all possible combinations of positive NPV projects, trying to spend as much money as possible, and see which combination gives us the highest NPV. For example, here we could do A plus B, which will give you 150 NPV, or A plus C, which would also give you 150 NPV, B plus C, which gives you 200 NPV, or A plus D, which will give you 180 NPV. So the combination of projects B and C give the highest NPV when the projects are indivisible, and this NPV equals $200,000. We've considered here the impact of having capital constraints and how D company can decide what to invest in to maximum effect. The company should make sure that it is definitely constrained as far as the amount of capital available is concerned before turning away positive NPV projects. It could consider, for example, delaying a project, leasing the assets, or trying to raise more finance. In our next video, we'll consider replacement analysis.